Topic 4, Uniform Capital Allowances. In this topic, we're basically going to deal with depreciation. And the first part that we're going to look at is actually the same depreciation that you've done in first year accounting. The thing is, we've got slightly different words, slightly different terms, but at the end of the day, it's exactly what you did in first year accounting. Then we move on to things like low value pools, depreciation for small business enterprises, and building deductions. And then the effect on the reduced cost base, having done all this new material. So let's start with the simplest aspects first. Under Division 40, a taxpayer can claim a deduction for the decline in value of a depreciating asset. Now, in accounting, we just called it depreciation. For tax, it's called decline in value. It's exactly the same thing. A depreciating asset is one which has a limited effective life and can reasonably be expected to decline in value over time as it's used. So we're not looking at something that's going to increase in value, but something that as you use it, its value reduces. The next thing is the rate. What is the rate of the decline in value? And that's established based on the effective life of the asset. How long do we anticipate this asset can be used? We can use prime cost or diminishing value. In accounting, you called it straight line and reducing balance. Same thing, different terms. And at the end of the period of time we've held the asset, we have a balancing adjustment, and it will be positive or negative. In accounting, you called this profit on sale of a depreciated asset or loss on sale of a depreciated asset. Again, the same thing, but for tax purposes, we call it a balancing adjustment. 40-25 is the operative provision, and it says you can deduct an amount equal to the decline in value for an income year of a depreciating asset you held for any time during the year. And under 40-25(2), you can reduce the deduction that is attributable to your use for a purpose other than a taxable purpose. So if it was your motor vehicle and you used it 80% for income earning and 20% for private, you would only deduct 80%. We know we apply this rate to our depreciating asset. A depreciating asset is one which is reducing in value. So what is a depreciating asset? We used to call it plant. And what does that mean? And if you look at the classic definition says the apparatus used by a business person for carrying on the business. Not the stock in trade which is bought or made for sale, but all goods and chattels, fixed or movable, live or dead, which are kept for permanent employment in the business. So it's what you're using to help you run the business. It's not your trading stock, because that's what you're buying or selling or making to on sell, but it's what you use. If you note this, if the function is to provide the setting or environment, it is not plant. But if the function is to provide the means or apparatus by which income is produced, then the item is plant. So, for example, if we look at curtain, the plant would be this laptop, the table, the camera which is recording this, there's a backdrop, and all sorts of pieces of equipment in this studio. They would be plant. In our lecture theatres, we would have chairs, sometimes there are desks, we have projectors and so on. They would all be plant, and we would calculate the decline in value or the depreciation. But plant is not the actual studio that I'm sitting in, because that's a building. So plant are the things we use in carrying out our business, or our work. So you may want to go back to our original taxpayers in topic 1 and think about the different plant that each taxpayer would be using. Now in 40-180, our assets that we depreciate can have 2 elements of cost. The first is what we actually paid to buy it, and that would be simple enough that you go in and you buy a truck. What was the cost of the truck? That's your first element. And the second element is anything that creates an economic benefit, something that you add to it or an extra expense you incur after you bought it. The example which we've taken out of the Act is Andrew buys a new tray and adds a canopy to his utility called a ute. The labour and materials that go into adding that canopy to it are economic benefits and will contribute to the current condition of the ute, and therefore they are second element items. Now, second element might not be added in till some later time, a year later, 2 years later. So you would depreciate it up to that point. Then you would continue depreciating the original asset, and then you would start to depreciate the second element as well when that becomes part of our asset. The effective life, we work out our rate based on the effective life. The effective life is how long we can use the asset to earn assessable income. So that's all our background. Now we're actually going to calculate the decline in value. We have 2 methods: prime cost, straight line, or diminishing value, reducing balance, as you would know it. Now, before we get to either of those, we need to look at this issue of low-cost assets for non-business taxpayers. I'm going to say it, non-business taxpayers. That is, taxpayers who are not running a business. This would apply to salary and wage earners or owners of rental property, or perhaps someone with an investment portfolio. But they are not in business. These taxpayers can claim a straight 100% deduction for any asset that costs $300 or less. So if I want a new printer in my office at home and I go out and buy a printer for $250, because I am not in business, I can deduct that $250 immediately. If, however, I had a business and I went out and bought a printer for $250, I could not deduct it under this section. So this is section 40-80. Now, students love this section. They get hold of it, and the minute they see anything under $300, they immediately write it off. But it only applies to non-business taxpayers. Also, be careful that it's not one of a series of assets that all cost less than $300. And the total cost would exceed $300. Okay, let's get back to our 2 methods of depreciation, prime cost and diminishing value. Have a look at 40-65, and then we're going into 40-72. Now, look at these sections, highlight them in your Act, because this is what we're going to use to calculate our decline in value. So using diminishing value, it says use the base value by the number of days held over 365 by 200% over the asset's effective life. The 200 over the asset's effective life is what gives you the rate. So when we talk about the rate of depreciation, we get that from that particular calculation, 200% over the effective life. Prime cost is the asset's cost by days held over 365. Remember, we're ignoring leap years. That's why we use 365. And here, it's 100% over the effective life. So in the first few years, you're going to get a much higher deduction using diminishing value than you are using prime cost because your rate is going to be higher. What do we mean by the base value for diminishing value? It's obviously your written down value each year. So if you bought it for $1,000 and the rate was 20%, you would deduct it and assume you've had it for the whole year. It would be $200. The base value the next year would be $800. Okay? Remember that, so it's always this decreasing amount. Remember with prime cost, it's on the cost of the asset. So if it was that asset for $1,000, then it would be $1,000 by 10% for 10 years. The good thing about prime cost is you finish writing it off in a specified time. With diminishing value, you go into this never-ending, slightly smaller value each year. There is a way around that, as you'll see shortly. I've got an example for you where taxpayers got two assets, each cost $1,500, each has an effective life of 12 years, each was born on the 1st of January. We're doing one on diminishing value and prime cost for the other. So what is the decline in value for each year? And previously you would have done closing written down value, opening written down value. Here we call it closing adjustable value, opening adjustable value. Exactly the same thing. So stop the presentation now and do that exercise and see what answer you get. So we're doing one at prime cost, one at diminishing value. Have a look now at our calculation. Under diminishing value, our base value in the first year was $1,500. We depreciated for 181 days. By the way, if you're struggling with days, remember our days of the year table at the back of the book. Our rate is 200% divided by 12, and we got a decline in value of $124 and an closing adjustable value of $1,376. Next year, that becomes our opening adjustable value. We depreciate for the whole year. If it's a whole year, don't worry about the 365 over 365. I'm just doing that to show you what we're doing. And it's still 200% over 12 because that gives you the rate and it doesn't alter because we're now 1 year into our calculation. Prime cost, same thing, except it's going to be 100% divided by 12 years. And then what happens in the second year? Remember that we still work on our cost price, not on our adjusted value. Now, what happens? And so it's that simple. What I find interesting about this part of the course is it's really mechanical, and yet students do really, really badly on depreciation. So if you establish your cost, you establish your rate, you take one from you multiply one by the other, you get your decline in value. It's that simple. You did it in first year accounting. So, it shouldn't be difficult. Now we come to selling the depreciated asset. One of three things will happen. You'll sell it for its depreciated value, you'll sell it for more, or you'll sell it for less. If you sell it for more or less, you have a balancing adjustment. If you sell it for the written down value, nothing happens. Again, you did this in first year accounting. It's profit or loss on sale of a depreciated asset. If you think about what it's doing, is the balancing adjustment is simply saying, if you bought it for one value, you've depreciated it down here, but you sold it somewhere in between, then really what happened was you've claimed too much depreciation, so some of it must be added back into your income because your deduction was too high. If, on the other hand, you bought it at this value, you wrote it down to this value, but you only sold it for this value, much lower value, then you obviously didn't claim enough depreciation. So you need to go back and depreciate it a bit more. That's your loss. That's your loss on sale of a depreciated asset, or for our purposes, it's a negative balancing adjustment. I compare it to a seesaw. You know, you've claimed too much depreciation, you have to give some back. Or you didn't claim enough depreciation, you need to claim a bit more. That's why it's called a balancing adjustment. You're balancing up at the end of the day. So if you sell it for more than the written down value, then you include it in income. If you sell it for less, it's a deduction. We've got a couple of examples here. It cost us 10. We sold it for 5. The closing adjustable value was 3. So we've got a balancing adjustment of 2, a positive one. If, on the other hand, the closing adjustable value was 6 and we sold it for 5, we've got a deduction. Our balancing adjustment is a deduction. Now, for a while, that was it. That was depreciation, and it finished there. However, we now have 40-420, which looks at this issue of low-value pools. Now, what the idea is here is if your asset is depreciating, rather than have your depreciation schedule full of these assets that are now worth, $800, $80, whatever, you can put those assets into a low-value pool. Now, a low-value pool is made up of 2 components, low-cost assets and low-value assets. A low-cost asset is one which costs less than $1,000 to buy. So it cost you $850, you put it into this low-value pool. Or low-value assets. They cost more than $1,000 or more to buy, but are now written down to less than $1,000. And again, we're going to put them into this pool. Now, if you think about a pool of water, once you put a drop of water into that pool, you can no longer look at the pool and say, oh, there's my drop of water. It becomes part of all the other water that's in there. Similarly with a low-value pool, once you put the asset into the pool, it no longer has an individual value. When we did our other assets, remember those 2 assets, we did one on prime cost, one on diminishing value. We could go through over a period of time and say, there's asset 1, it's now written down to X. There's asset 2, it's now written down to Y. When we put our assets into the pool, we can no longer establish a separate value for that particular asset. So what we do is we talk about a pool balance. So we've put this asset in for $850, we've put that asset in for $700, we had other assets. We don't say, oh, there's that asset and it's worth this. We simply say our pool balance is now worth $25,000. Because we've got all these different assets in there, which all are now worth less than $1,000. Even if they cost more, they've come in when they were less than $1,000, or they're all these assets that cost less than $1,000 to buy. So 2 elements to our cost base. Remember that $300 rule doesn't apply here because that $300 rule applied for assets that were fully deductible and the taxpayer was not carrying on a business. The other thing is this section does not apply to prime cost assets because they're going to be written off in a specified period of time. So we're looking here at section 40-425, subsection 5. And it excludes SBE taxpayers because we've got separate rules for them, which we'll look at in a minute. Now, in 40-430, the rule is this. Once you put a low-cost asset, it cost you less than $1,000 to buy, you must subsequently put all future low-cost assets into the low-value pool. So if I buy a new printer today for $800, everything else I buy in future that costs less than $800 has to go into that low-value pool. On the other hand, low-value assets don't have to go into the pool. You can choose. Now, for example, you might say, oh, I want to tidy up my depreciation schedule. I've got all these small things. And you might put 4 out of 5 into the pool. The one you leave out is the one that you're about to sell that year, and you know you're going to sell it at a loss because it's now, even though its adjustable value is $800, you know because it's been so heavily used, you'd be lucky to sell it for $400. So you'd keep that one out, pick up the balancing adjustment plus the decline in value, but you put all your other assets into the pool. And that way you don't have to keep a big depreciation schedule. So how do we calculate the decline in value here? 4 steps. Firstly, you work out the amount obtained by taking 18.75 of the taxable use of the cost of each low-cost asset you allocated that year. So if it's a new asset you bought, the rate is 18.75%. You add to that 18.75% of any second element costs that were included that year. So an existing asset, now you've added to it, maybe you had a van and now you've put in a new motor. That would be 18.75. Anything new is 18.75. 37.5% of the closing pool balance of the previous year, plus any existing assets that you're going to put into the pool, so assets you've already owned. Now, when we come to this bit, students get really confused, and it's really very simple. If you buy new assets, you get half the rate, which is 18.75%. Assets you've held since before the start of the current year, 37.5%. If you had a business and you wanted to buy some low-cost assets close to the end of the year, you're better off buying them in May or June. You pick up your 18.75, and then for the next year, you get to 37.5. The closing pool balance is your cost of your new assets minus the decline in value plus your existing assets minus the decline in value, and that's your closing pool balance. Now, if you happen to sell any assets during the year, you will reduce that closing pool balance by the sale price. Because remember, you can't do a balancing adjustment. So what you're saying is, well, at the end, this was my pool balance and it's been reduced because I sold an asset for $2,000. Now that would make you think you've probably got a profit on sale, but you don't know because you don't know the individual value of that asset. So it simply reduces your pool balance. So I have an example for you here. Business taxpayer, existing low value pool with a balance of 3,930, buy a new asset for 610, existing assets sold for 200. We've got 18 low value assets that we're going to pool during the year. Their value was 15,000. Calculate the impact on the taxpayer's income. Stop the presentation, do that example now. You can see that we take the old assets plus the assets we've put into the pool, the low value assets, multiply those by 37.5. Then we take the new assets, multiply them by 18.75 to give us our decline in value. So that's going to be our deduction, the 7213. We have a closing pool balance of 12, I can't see the figure, 371, I think. And then we take off our sale of 200 to give us the closing pool balance. Now that closing pool balance becomes next year's opening pool balance. So that's it for low value pools. A couple of rules. New assets, half the rate, 18.75. Existing assets, 37.5. Once you put a low cost asset in or future low cost assets go in, you can choose which low value assets to go in, and any assets sold, it reduces the pool balance. Now we're going to look at SBE taxpayers. Now, very similar things. SBE taxpayers have 2 pools instead of 1. The same pooling rules apply, how we calculate the closing balance. Now with SBE taxpayers, the big thing that they have is this low cost asset that costs less than $1,000 can be immediately deducted at 100%. So if you bought something for $900, you just claim a deduction of $900. We then have a general pool, a long life pool. The general pool applies to assets with an effective life of less than 25 years. The rate here is new assets, 15%, existing assets 30%. Same rules apply. Opening balance 30%, new assets 15%, add them up and take off any sales to get your closing pool balance. The long life pool, assets with an effective life of 25 years or more, and the rates are 2.5 for new assets, 5% for existing assets. Now, this is absolutely mechanical. In the back of your book, you will find the different depreciation schedules. The best advice I can give you is to go and copy each of those schedules and work every single question in the appropriate schedule. We will not mark them in the exam if they are not done on the schedules. So you must work them on the schedules. The other thing is the schedules make them really easy because there's a section, put in your cost, put in your opening balance, here's your rate, here's your decline in value, here's your closing balance. Now, last year, one of the exam papers had an SBE taxpayer who bought something for $900. Now, it was so obvious that students had not used the schedules. And I cannot tell you how many students, the asset was something for $900, and they put it in as the cost, and then they just simply went across and showed it as the closing pool balance, when of course it was the decline in value was the $900. So you're really just throwing away marks. So if you get used to using the schedules, then it'll make your life much easier. Some students come to me and say, oh, we find the schedules really difficult to use. And my comment is, what are you going to do when you go out to work and there are things you have to use at work? You can't just say, oh, don't like it. If you can work out a better way of doing it, that's fine. But generally, if you've got schedules in place, you will be expected to use them. And they're only difficult because you don't use them and then you try and use them in the exam, and that's when you have a problem. So please use them beforehand. There is an example here for an SBE taxpayer, and what you might like to do is go through and work out how you would fill out the schedule for that taxpayer. Once again, you might like to actually use your schedule, do this example, and then come back and compare it to my answer. So in summary, if you're not in business and the asset costs $300 or less, you have an immediate write-off of $300. Prime cost, you use the cost of the asset and you use 100% over the effective life. Diminishing value, it's the base value, which is basically your depreciated value. And the rate is 200% over the effective life. You have balancing adjustments, which are positive or negative, depending on the comparison between the sale price and the closing adjustable value. You have the option of using a low value pool, which covers low cost assets and low value assets. Low cost assets cost less than 1,000. Low value assets cost more but are now written down to less than 1,000. They can only have been used, depreciated using diminishing value. If you sell pooled assets, it just reduces the closing balance of the pool. SBE taxpayers have low cost assets less than 1,000, 100% deduction. And then for their pools, they have general pool using 15 and 30, long life pools using 2.5 and 5%. Before we move to buildings, just remember that for intellectual property like patents and things like that, have a look at section 40-95(7). You can only use prime cost and the effective life is given to you in that section. So highlight that section and come back to it when you look at things like patents and trademarks. Division 43 is the amortization of income producing buildings. Now remember, Division 40 was plant. Division 43 concerns buildings. It gives you a deduction of 2.5 for 40 years or 4% for 25 years, and it works on the capital cost of construction of a building. The whole idea was to reward people for constructing buildings. Because remember, constructing a building is a capital cost, so there's no deduction. So this section says if you construct a building, whoever owns that building for 25 or 40 years can get a deduction. But it always works off the cost of constructing the building. So if it originally cost $1 million, then it's 2.5 or 4%, and that will become clear to you in a minute, for the appropriate number of years of $1 million. Now, if someone subsequently buys that building for $1.5 million, their deduction is still based on the $1 million cost of construction. How do we work out the rates? The rates apply based on when construction commenced. That's basically when the footings were put down. Now, in our questions, I'll say to you, construction commenced on such and such a date. Now, basically, what happened was it came in about 1982. The rate was 2.5%. So if a building was constructed in that time, commenced to be constructed, the rate was 2.5. Then the rate went up to 4%, then it dropped back to 2.5%. Initially, it didn't cover residential properties, such as houses and apartments. It now does cover residential properties. If you look at the table in the back of your unit guide, which remember will be given to you in the exam, you'll see it covers residential and non-residential properties. And you've got the rates in there. So it's a simple case of looking up when did construction commence. Once you establish the rate, you multiply it by the cost of construction and then the number of days the building was used for income earning purposes during the year. So that's really pretty simple. The only complication is that in February 1992, the government decided to give a higher rate of 4% to buildings that were involved in eligible industrial activities. And these are buildings in which something is manufactured. So it will basically be a factory, it can be a bakery or something like that. So for those buildings, you'll use 4% if construction commenced after the 27th of February 1992. So let's have a look. Students seem to have a problem with what sort of buildings we're concerned with. So we would start off obviously with residential buildings, being things like houses, flats and apartments. Non-residential buildings would be things like offices, showrooms, warehouses, factories, and the eligible industrial activities are carried out in factories. So you would look at it if it was an apartment or a house, then you'd look up the residential ones. If it was a shop, an office building, then you'd look up the other buildings, and after February 92, if it was a factory, then it's got a different rate again. Now, the last thing we need to look at is, because we've been able to now calculate this Division 43 deduction, we can now actually calculate a reduced cost base. In Topic 3, we simply went through for reduced cost base and ignored element 3. But now, whether it's mainly it's for reduced cost base that we're going to look at here, we can now reduce the cost of the asset by any Division 43 deduction. So if you have a rental property, an office building, something like that, you can take into account the fact that the Division 43 deduction reduces the cost of that building. So we've now finished Topic 4. We've learned all about depreciation, and we've done Division 43, which is it's a building deduction. It's not depreciation, even though we will show it in our depreciation schedule. And that's usually done for ease of operation to put it in there. Remember that Division 43 deduction is, the closest comparison is it's like prime cost, because it's just a deduction for 25 or 40 years on the cost of construction, but there is no balancing adjustment on sale, but it will affect the cost base or reduce cost base of the asset.